Welcome back to Investing Talk Podcast.
Today we're looking at Robinhood Markets. And frankly, if you still think of this company as just the meme stockbroker from 2021,
The GameStop era.
exactly, the GameStop era, the Dogecoin frenzy,
Yeah.
you are looking at a really outdated picture.
Right.
We were talking about a company that just posted full year 2025 revenue of $4.5 billion and, get this, net income of $1.9 billion.
It's a profitability story now.
It really is.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us out.
It does.
But, okay, before we get too excited about those billions you just mentioned, let's look at the immediate context. Because while the full year looked great, they did miss revenue expectations in Q4.
They did.
So the big question we need to answer today is this a growth stall, or is this actually a buying opportunity in disguise?
It is the right question to ask.
Mhm.
And to answer it, we have to really get under the hood of these numbers.
Let's do it.
Because the headline number, that revenue miss, it hides a much more interesting transformation happening in the business model.
Okay, so let's unpack that. You mentioned the full year was massive, up 52% to $4.5 billion. I mean, that is undeniably huge growth.
Huge.
But we are recording this in February 2026, looking back at Q4 of 25. And in that quarter, revenue was $1.283 billion.
Right.
That's up 27% year over year, sure, but the consensus expectation was $1.34 billion. They missed the mark.
They did miss on the top line. But here is where it gets fascinating. Look at the bottom line.
Okay.
Despite that revenue miss, their earnings per share EPS came in at $0.63.
Okay, help me reconcile that for a second. They brought in less money than Wall Street expected, but they kept more profit than expected. How does that math actually work?
It comes down to two words: operating leverage.
Ah.
And this is probably the most important concept for this entire episode.
Break that down for us. What does operating leverage actually look like in practice here?
Okay, think of it like a software business versus, say, a grocery store. If you run a grocery store and you want to sell more apples, you have to buy more apples.
Of course.
Your costs go up almost as fast as your revenue. You have low leverage.
Right. Margins are thin.
Exactly. But Robinhood is a tech platform. Once they've built the app, the trading engine, all the compliance servers, adding the next million users costs them almost nothing.
The fixed costs are already there.
They're already there. They stay relatively flat.
Yeah.
So even though revenue grew slightly slower than the analyst hoped, their costs grew even slower.
And that difference just drops to the bottom line.
Straight to the bottom line as pure profit.
So they've reached that inflection point where they don't need to spend a dollar to make a dollar anymore.
That's it. They are squeezing more juice out of the orange. And that right there is why the stock didn't crash on the revenue miss.
The market loves efficiency.
More than it loves raw growth right now, yes.
That is a fair point on efficiency. But we have to address the elephant in the room regarding that revenue miss. It was crypto, right?
It was.
I mean, looking at the data, crypto revenue cratered 38% in Q4, down to $221 million. That is a massive drop.
It is significant, and it reflects the broader market weakness we saw in Q4.
Yeah.
But this is exactly why the stock didn't collapse.
Yeah.
The revenue base has shifted dramatically. 2 or 3 years ago, a 38% drop in crypto would have been catastrophic for them.
It would have wiped out their quarter.
Completely. But this time, it didn't.
So what picked up the slack?
Look at the other numbers. Options revenue jumped 41% to $314 million.
Wow.
Equities trading climbed 54% to $94 million. I mean, they are seeing engagement across the board.
But there's another piece here.
Yes. The stat that really matters, the one that changes the thesis, is the net interest income.
Let's talk about that. Because usually when people hear net interest income or NII, they think of boring banks like JP Morgan or Wells Fargo.
You know, it feels weird like.
It feels weird applying it to an app famous for meme stocks.
It does, but that's the pivot. NII surged 39% to $411 million. This is boring, reliable money.
And it isn't made from people frantically day trading.
Not at all. This is money made on cash balances, margin lending, and securities lending.
Wait, explain the securities lending part. That's a bit opaque for most people.
Yeah.
How does Robinhood make money lending out shares?
It's actually fascinating. So let's say you own 100 shares of Tesla in your Robinhood account. You're just holding it long term.
Okay.
Robinhood can take those shares, lend them to, say, a hedge fund that wants to short Tesla, and charge that hedge fund interest.
And Robinhood just pockets that fee.
They pocket a chunk of it, yeah, and they share some with the user. But when you aggregate that across millions of users, it becomes a massive revenue stream.
That has nothing to do with trading activity.
Zero. It turns them into a bank, essentially, rather than just a casino.
And speaking of not just being a casino, well, maybe this is a bad example because it literally involves betting, but let's talk about the prediction markets.
Oh, yes.
That feels like a brand new vertical that came out of nowhere.
It's explosive. Prediction markets generated $147 million in Q4 alone.
$147 million.
That is more than triple what it did the prior year.
That is wild.
It is. It's becoming a serious pillar of their business. So when you step back, they now have 11 distinct business lines generating approximately $100 million or more in annualized revenue.
That is a level of diversification I don't think most people credit them for.
Not at all.
And the margins on that are impressive. I'm seeing a profit margin of 52.18% and a return on equity of 27.82%.
I mean, those are numbers that would make a lot of legacy banks jealous.
Absolutely.
They absolutely would.
Yeah.
But if you want the single most bullish stat for future growth, if you want to know where the stock is going next, you have to look at the deposits.
Okay.
This is the lifeblood of that net interest income we talked about. Net deposits were nearly $16 billion in Q4 2025.
$16 billion. And that momentum hasn't stopped, right?
Not at all. We have data for the early part of Q1 2026, and net deposits have already hit $7 billion.
Just in the first few weeks of the year.
Just in the first few weeks. That represents a 19% annualized growth rate relative to their assets.
That is what they call sticky money. People aren't just depositing that to trade and leave. They are parking cash.
They're parking it.
Why? Is it the gold card, the ecosystem?
It's the whole ecosystem. They're offering high yields on cash, the credit card, and now the banking rollout.
And I assume that is critical for this new banking push to gold members.
It's essential. As they roll out banking services, having that $7 billion inflow in Q1 gives them a massive capital base to lend against.
It changes the relationship.
It transforms relationship with the customer from transactional, I use you to buy Apple, to foundational, I keep my life savings here.
Okay, so the fundamentals show a company that is diversifying and gathering assets at a rapid clip despite the crypto volatility.
Right.
Let's pivot to the charts and see how the market is actually reacting to this data. Because looking at the price action around earnings, it was a bit of a heart attack monitor.
It certainly was. We saw highs of $76.72 and lows of $72.87 on February 16th, right around the release.
Which is typical.
It's typical volatility when you have a mixed report revenue miss, earnings beat. The market has to figure out which number matters more.
But then we saw what you might call a reset and reprice.
Yes. In the session following the report, the stock rose 6.82% to $81.15.
And that tells you everything.
It tells you everything you need to know about institutional sentiment. The big players likely use that initial dip to re-enter or build positions.
So they're looking past the crypto blip.
Completely. They're focusing on that EPS beat.
And for context, we have to remember where the stock has come from. It surged 204% throughout 2025.
An incredible run.
It is sitting well above pre-crypto boom levels. So this isn't a recovery play anymore. It's a momentum play.
It is, but the drivers of that momentum have changed. In 2021, the driver was hype.
Right.
Now, the market behavior indicates a shift in valuation drivers. Investors are rewarding the profitability. They're paying for that $1.66 EPS.
So the fact that the price held up and rallied after a revenue miss proves that profitability is supporting the price now.
Exactly. Not just hype.
It seems like as long as they hold these post-earnings levels, the psychological state of the market remains bullish.
I agree. Despite the consolidation near recent support, the trend remains bullish. The market is effectively saying, we forgive the crypto miss because the banking and options businesses are printing money.
So the charts look resilient, but what is the street actually saying? Let's look at sentiment.
Yeah, let's.
Because there is some interesting news hitting the wires that goes beyond just the earnings report, specifically something called the RVI.
This is huge news. The Robinhood Ventures Fund, or RVI.
This is the IPO happening on the NYSE, right?
Yes. They are launching a fund, ticker RVI, offering 40 million shares at $25 a share.
This is a fascinating move.
It is, because it is essentially democratizing access to pre-IPO tech companies.
Explain that distinction. Why does that matter?
Historically, if you wanted to invest in a company like SpaceX or Stripe before they went public, you had to be an accredited investor.
Right, a venture capitalist.
Venture capitalist, ultra-wealthy individuals. Normal people were locked out until the stock hit the public market, usually at a much higher price.
So Robinhood is packaging that access.
They're packaging that access and selling it to their user base.
And from a business perspective for Robinhood, that is a brand new revenue stream. Asset management fees.
Precisely. It validates their strategy to expand beyond public markets. It creates a moat. If you want pre-IPO access, you go to Robinhood.
And speaking of validation...
You have to mention the Cathie Wood effect.
Ah, yes. Love her or hate her, when she moves, people watch.
ARK Invest recently bought both Hood and Coin. It signaled that high-growth funds are accumulating.
They see it as attractive.
They view this current valuation as attractive, even after the 2025 run-up. It's a vote of confidence in the long-term secular trend of digital finance.
What about the broader analyst community? Because usually, when a stock runs 200% in a year, analysts start to get cautious and say it's overvalued.
We aren't seeing that yet. The price targets for 2026 are quite wide, I'll grant you, ranging from roughly $80 on the low end to $164 on the high end.
But the consensus is still bullish.
Definitely bullish. The median target suggests there is still significant upside from this 8110 level.
And there is a structural reason for that buying pressure too, isn't there?
The S&P 500 inclusion. You cannot understate how important that is.
Why is that such a big deal?
Because it forces index funds to buy the stock. Think of all the retirement accounts, 401ks, and pension funds that blindly track the S&P 500.
They have to own it.
When Robinhood gets added, all those funds must buy shares to match the index weighting. It creates a permanent structural tailwind for inflows.
And management seems to agree that the price is right because they are actively repurchasing shares.
That's the ultimate signal. When a company buys back its own stock after a 200% run, they are telling you, we still think it's cheap.
They think the market is still wrong.
They believe the market is underestimating their future earnings power.
Everything sounds great, but we need to look at the risks. We are not doing our job if we don't look at the other side of the coin.
Absolutely.
Let's dive into the bear case, because that Q4 crypto miss, it wasn't just a small miss, it was 38%.
It was significant. And looking at the data, despite high trading volumes, $82.4 billion in notional volume revenue dropped.
Which means spreads are shrinking.
Exactly. They're making less money on every crypto trade.
And Mizuho analysts have been warning about this crypto winter. If Bitcoin creates a drag, that $221 million revenue bucket could shrink further.
It is a valid risk.
If we see a prolonged downturn in digital assets, that is going to hurt.
It is. However, I would point back to that net interest income growth. They are 39% up in NII.
So they're less dependent.
Significantly less dependent on crypto than they were 2 years ago. So while a crypto winter would hurt, it wouldn't be fatal like it might have been in the past.
Let's look at risk number 2. And honestly, this is the one that keeps me up at night regarding fintech regulation.
It's the dark cloud that never really goes away.
We raved about the prediction markets earlier, tripling revenue, huge engagement.
Right.
But we have to look at what's happening in Massachusetts with Polymarket. They are under fire.
They are.
If the CFTC or the SEC decides that betting on the outcome of an election or a Fed rate cut is gambling and not investing, that entire vertical could get zeroed out.
That is a very real threat. Prediction markets exist in a gray area right now.
A very gray area.
They argue it's a hedging tool like buying insurance against a bad election result. But regulators aren't known for their sense of humor.
They definitely are. And it's not just prediction markets. We still have the payment for order flow PFOF issue lurking.
PFOF is how they offer commission-free trading. Market makers like Citadel pay Robinhood for the right to execute your trade.
Which the SEC is not a fan of.
Not at all. If they decide that creates a conflict of interest and bans it, which they have threatened to do, Robinhood's core revenue engine for equities sputters out.
And they have to start charging commissions.
Which kills their user growth.
And finally, risk number 3, the valuation premium. We talked about how profitable they are, but this stock trades at a forward PE of 27x.
It does it.
The sector median for financials is near 10x. That is a 160% to 175% premium. You are paying a luxury price for this stock.
You are. But the counterargument is that you pay a premium for quality.
Explain.
Traditional brokerages do not have 52% margins. They don't have a 27% return on equity. And they certainly aren't growing revenue at 52%.
So you're paying for growth and efficiency.
Exactly.
True. But the danger with high multiples is that if growth slows even a little bit, that multiple has a long way to fall.
That's the risk.
If they trade down to a 15x multiple, the stock price gets cut in half.
That is the risk. You are betting that the growth continues to justify the price tag.
We've weighed the growth against the risks. We've looked at the massive deposits, the diversification, but also the regulatory clouds and the high valuation.
Okay.
It's time for the verdict. What is the score?
When you look at the total picture, The transformation into a diversified powerhouse, the institutional credibility, and the massive cash inflows, I am assigning a bullish score of 8.2 out of 10.
8.2, that is a strong score. Walk us through the core thesis one last time.
The thesis is simple: evolution. Robinhood is no longer just a trading app. It is a fintech ecosystem.
Right.
They have 11 business lines. Net interest income is surging. They have created a sticky ecosystem where users park cash $7 billion in Q1 alone.
And you have catalysts ahead.
The catalysts ahead, like the RVI IPO and the banking rollout to Gold members, are going to drive margin expansion even further.
So how do we trade this? What are the price targets?
For a swing trade, looking short-term into the end of Q1 2026, I'm targeting $95 to $105.
And what are you watching for there? We want to watch the earnings in late April. If those Q1 deposits we saw translate into margin expansion, the stock will pop.
And for the longer term, say 12 to 24 months.
If the RVI IPO works and the banking division matures, I'm targeting $120 to $150. This aligns with the upper end of the analyst estimates.
Because the market will start valuing them differently.
The market will stop valuing them as a broker and start valuing them as a high-growth asset manager.
I think the deduction from a perfect 10 is fair, that 27x valuation is steep, and the regulatory risks on prediction markets are non-zero.
For sure.
It keeps it from being a perfect setup, but 8.2 is compelling.
It is. The key takeaway for the listener is that the market is currently repricing them. They are moving from being seen as a volatile trading app to a stable asset gatherer. And asset gatherers command higher valuations.
That's it for today's analysis. Make sure to subscribe, like, and drop a comment on what stock we should cover next. Thanks for listening.